So Andy, this white paper is called COVID-19, Accelerating Our Journey to Inequality. And it's available on our website, montica.com, for those who want to read it in full. Andy, you worked on this white paper for about 6 months, and it was published in December late last year. And before we get into the actual white paper, I'd like to ask you how you came to be writing on this topic.
Yeah, so look, I guess it all came about in the depths of the pandemic last year. And, during that time, of course, we knew the world had changed fundamentally. The question was how. In some of the discussions we were having with our investors, actually it's one of our larger investors, put a really simple question to me, which is, he said, Andy, tell me where you see the world going over the next 10 years. And really with that simple question, that sparked this entire analysis. And so, we decided to go back to first principles, look at the historical precedents and also review the most recent academic research. And so really the white paper is just a summary of how we see the economic system and then, how COVID has sort of impacted that system and then ultimately what the implications are for investors.
Okay, so why don't we start with this idea of an economic system? The white paper uses a system as a framework for your analysis. So can you start by introducing the economic system as you see it?
Yeah, sure. So look, really, in order to arrive at the construct of this economic system, we really built on some of the work that we did internally back in 2019. So as many of you will recall, 2 years ago, we just gone through a period from 2016 to 2018 where interest rates had increased from about 1.5% up to 3%. At that time, the conventional wisdom was very much that this was just the normalization in interest rate policy that everybody was expecting after, like a decade of emergency monetary settings following the GFC. And of course, what happened was, fast forward to the fourth quarter of 2018 and the higher interest rates in the US, while they could certainly have been supported by the US economy, which was absolutely humming at the time, that monetary tightening actually affected the rest of the world, particularly emerging markets, and that really started to impair growth. And we actually saw a pretty severe equity market sell-off at that time. And so that actually sparked a question for us internally in early 2019. We posed the question to ourselves, could, the conventional wisdom that rates are going to normalize, could that actually be wrong? And could we actually be heading through a world of much lower interest rates for a much longer period of time? And so what we did was, to answer that question, we really tasked ourselves with the job of just thinking about the economic system and thinking about the drivers of long-term interest rates. And so at that time, we pulled together really our first cut of the economic system, and that's shown on the screen here now. And what really jumped out at us was that there were two really big exogenous or external forces, if you like, that were ultimately disinflationary. And one is around technology and automation, which is really has only just started and is really starting to hollow out large swaths of the labour force in various industries. And that obviously is not good for wage inflation and is a disinflationary force. And then the other is ageing populations all over the world, which really stretches government budgets and drives up government indebtedness as they have to fund increasing healthcare and social security liabilities. So when we looked at this sort of first cut of the system and we looked at the drivers of interest rates, we ultimately concluded that most of these drivers were structural in nature, not cyclical, and were only going to continue for the foreseeable future. And most of these drivers as well are global forces, not local forces. And so we concluded at the time that, we could well be facing a lower for longer interest rate environment. And that, of course, had pretty important implications for asset prices. So We fast forward now to 2020 when we revisit this economic system, and we try to build on it a little bit because we thought there were some important dynamics that were missing from our first cut that we did 2 years prior. So for example, and you can see it on the screen now, for example, we observed that worker power has been in structural decline for decades, and that's primarily as a result of reduced union or labour union membership, as well as increasing competition from sort of international low-cost jurisdictions, as well as increasing competition, with robots, with machines, with automated AI. This is ultimately disinflationary, doesn't do much for wages in the aggregate, and results in higher asset prices as well. Another example of something that we added to our economic system here is, part of our review of the recent academic research really shows how low interest rates reduces industry competition and productivity. And both of these things actually drive up asset prices higher. And one of the things that really jumped out of this analysis was that really all roads lead to inequality. As we analysed inequality, we noticed that inequality has really become severe over the last 40 years, especially in the US and the UK.
Okay, yeah. So let's zero in on that inequality, and I understand why extreme inequality is not good from a societal perspective, but why is it bad from an economic perspective?
So one of the really important insights that jumped out of our analysis was this idea that inequality creates a feedback loop back into the economic system. And what that does is it really exacerbates or compounds the various dynamics that lead to low inflation, low interest rates, and higher asset inflation. One of the ways in which this happens, or one of the channels through which this happens, is around the increased indebtedness. So this idea that inequality actually drives indebtedness, it's not necessarily intuitive, but the dynamic is something like the following. While most regular people basically spend what they earn, the very rich do not. I mean, they essentially earn or have assets that cover multiples of their spending needs. So what happens is that when the rich get richer, that in and of itself doesn't really drive higher consumption. They tend to accumulate additional assets. And in the aggregate, the value of those assets is really dependent upon the continued consumption of those people in the lower earning cohorts who have a progressively lower share of national income. And so basically the only way you can square that circle is if those lower earning cohorts borrow a lot more money. And so what you can see when you look at the evidence over time, especially since the 1980s, and just shown on the screen here, you can see that net household assets for the top 1% over the last 40 years have gone up. So the very rich have accumulated more assets, whereas the bottom 90% have accumulated vastly more liabilities. So this inequality dynamic is really exacerbating indebtedness at particularly the household level. And that, of course, makes the system more fragile, more susceptible to crises, and really means the system just simply cannot tolerate higher interest rates.
Yeah, okay. Very interesting. So, so now tell us what you see the impacts of COVID-19 are on this economic system going forward.
Sure. So we come back to our economic system that we devised, which we're showing on the screen here. And then, of course, we ask ourselves the question, so where does COVID-19 fit into this picture? If I just add it to the picture now, it's that top bubble in the middle. Really, it seems to us that the pandemic was another major exogenous or external force that did three things. It really exacerbated underemployment, it hurt economic growth, and it drastically increased indebtedness, particularly at the government level, but also at the household and corporate levels as well. And so really through this lens, we view COVID-19 as a great accelerant of an economic system that was already leading to a sort of a lower growth, lower interest rate, higher asset price / higher inequality model. It's sort of pouring sort of kerosene on that fire, if you like.
Yeah. Okay. So maybe a good thing to do is just bring it back into what that actually means for investors, and what they should be thinking about, how to position their portfolios over the coming years. And I like.
Yeah. So no worries. So yeah, we basically came up with 5 simple guidelines for investors who are thinking about how to position their portfolios over the coming years and decade. Mm-hmm. And it won't be surprising to any viewers that the Montica portfolio really adheres to these simple ideas. So just stepping through them really quickly, based on what we see in this economic system, you should have a preference to own equities, not bonds. You want to own high quality growers, not those businesses which are more linked to GDP growth. In this day and age, you really want to own the businesses that are long-term technology winners. And we've talked about digital transformation in other forums, but you really want to own those that have expanding data advantages. You want to own businesses that have wealthier customers, all else being equal. Obviously, inequality is more beneficial for the wealthier customers. And then, we think you also want to avoid too much, cross-border exposure, whether it's on the supply chain side or whatnot, given what we see as an ongoing trade dispute between the US and China.
Yeah.
So they're the 5 things. Look, the truth is, we've written down 5. If we had to pick 2, really number 2 and 3 are really key, we think, at the moment. And number 2 and 3 really underpin a lot of the names in our portfolio today. Okay,
so maybe that'd be a good point then to give us an example of something in the portfolio that sort of sits within these sort of parameters.
Yeah, so take Microsoft, for example. And really there's no question that Microsoft is one of the most important technology platforms in the world. Basically underpins applications for governments, corporates, and households alike. And there's a very high probability that in the fullness of time, over the next 10 years and beyond, Microsoft will play a critical role in this respect, given their enormous scale and data advantages. But, so here's what we mean about a high quality grower. If you think about what drives Microsoft's revenue today, it's really IT spend. IT spend as a percentage of global GDP is about 5%. Over the next 10 years, that will go to about 10%. And what this actually means in terms of dollars is that there will be an incremental about $6 trillion per annum up for grabs in terms of additional revenues over the next 10 years. And that 6 trillion is fairly independent of what aggregate GDP growth does. Right. So it's fairly safe to assume that Microsoft will take a meaningful share of that incremental 6 trillion. And that's a big number compared to Microsoft's revenue today of only 150 billion. So that's what we mean about a high quality grower. It's where the growth is really independent of aggregate GDP. Contrast that with something like a General Electric or some type of industrial conglomerate of that nature, where their revenue is really just driven by the aggregate GDP growth. And as we discussed, all of our analysis says that, longer term, we're probably looking at a kind of a low inflation, low growth type of environment. So under that environment, we think it really makes sense to own a Microsoft over a name like a General Electric.
Yeah, okay, that's interesting. And so maybe just to close out this section, I'm sure a lot of people would be wondering as well, inequality and how does this inequality ever reverse? How do we ever get back to a better state?
So you've asked, that's probably the most important question that you can ask. And unfortunately, we don't actually have the answer. What we can say is a couple of things to help sort of frame the way to think about that. And there's really good news and bad news. I'll start with the bad news first. The bad news is that historically, large-scale global wealth redistributions have not been pleasant, and they've typically followed periods of very intense political instability, such as following the French Revolution, such as following the Great Depression and the Second World War. So that's not a great historical precedent. The good news is that inequality is 100% political and ideological. So it is actually within the power of humans to change this through the political process if we so chose to do so.